Okay, let me now welcome on board Pankaj Mittal, the COO, and Kunal Malani, the CFO at Samaratana Motherson, joining in on the show right now. Gentlemen, morning. Great to have you both on the show. If I could just start off with you, Kunal, firstly, the markets honestly weren't expecting such a stellar show from you all, especially given the uncertainty around tariffs and, of course, a visible slowdown in demand as well. But you've managed to deliver a very strong set of numbers yet again. What really worked so well operationally this quarter for you?
No, so first of all, I think we had highlighted this even in the last quarter that we expected last quarter to be the weakest, and we expect every quarter to thereon look better, which is exactly what we have delivered. In fact, if you look at our history, there's a fair amount of Capex that we had spent in the past. There's a large order book that we had highlighted, which was all highlighting the fact that we should be growing as we move ahead. There was volatility obviously caused by tariffs and some of the geopolitical challenges that were associated with it. But like with everything else, with time, a lot of these things find its own water or own level, and hence, much of that seems to have been taken in the stride, and people have found solutions in and around the same. So overall, I think the team has reacted very, very well with the challenging times that were presented. They worked very hard on building some of the newer processes that are required to meet the revised, let's say, world dynamics. Also, I think some of the transformative measures that we had taken in April has aided us in managing our costs better and thereby improving our bottom line. Plus, mind you, our leverage is at 1.1x. We continue to be fairly strong on the balance sheet, which is then presenting with us a lot more opportunities both on the organic and inorganic side.
Right. Pankaj, like Kunal just mentioned, that second half is expected to be better than what we've seen in the first half. Can you help quantify that and also give us a sense of how the integration of Atsumitech is progressing? Any early synergies that you're currently seeing?
Well, Atsumitech's integration is doing very well. So it's been just the second quarter. And if you see, it will be around 870, 900 crores of revenue of Atsumitech, which comes in. It's doing very well. It's actually supporting in many different areas because it has huge capabilities in automation, machine building, a lot of other activities. And it's also on a phase in which it can pivot into many different areas. And one more thing which has happened is the way we are structured, the way the group grew around the world, being globally local has helped us because being local meant that our teams could be nimble-footed. They understand the markets, the customers very well, and can manage the change. So that's what has resulted in good results. As we move forward with confidence as whatever restructuring measures we had to take. If you see our polymer division's performance, it's improving. We have restructured, and these restructuring costs are there in this quarter as well. As we move forward, they will fade away, and the improvements will continue to benefit the company. In fact, tariffs also didn't impact us much, but we do carry the lag because there is a lag of about $10 million of tariff costs, which we have booked this quarter, which over a period of time will get paid by the customer. So there is a pass-through mechanism which has been negotiated with the customers. We have been dealing with them because these are extraordinary costs.
Right. But Pankaj, since your Capex plan is well underway, what's the latest update there and how is it that you're planning to fund this? Are you open to taking on more debt or will internal accrual suffice?
So we believe that we had given a Capex guidance of about 6,000 crores plus minus 10%. We believe that we will be within the Capex guidance, maybe on the positive side, as we see the plants ramping up. And especially our consumer electronics business also, we have been growing and investing in the plants. So that's the kind of growth which we see. And there are 10 plants which are already under construction. 2 of them have already come in production this quarter. So we continue on our growth phase.
Hi, Kunal. This is Harsha. Let's talk about the non-auto segment. That contribution is clearly rising, and it's also a higher margin business for you. How are you looking to expand this basket further, and what are the new margin opportunities within the non-auto space that you can talk to us about?
I think we had in this 5-year plan transformed ourselves into what we call DEMA, Design, Engineering, Manufacturing, and Assembly Powerhouse. And we are aiming to be industry agnostic, and hence a lot more newer segments, a lot more newer customers are part of the strategy that we will be embarking on going ahead. Among the existing ones, I think consumer electronics and aerospace both seem to be growing at high double digits. So obviously, it's growing at a much faster pace than our automotive businesses, and thereby the share of business of non-automotive continue to improve. These are also places where a large amount of Capex has flown in, and as the ramp up of this will happen, you will see that the bottom line, which is obviously much higher in these businesses than automotive, would also aid the overall margin profile and ROC profile of the company. The order book, just to highlight, between these two businesses was 2.7 billion 6 months back. Today, it is 3 billion already. And we continue to see a lot more traction in both these businesses. So that's the same path that we want to adopt for every other DEMA endeavor that we have. And as we progress through this 5-year plan, I would imagine the share would considerably inch up from the 5% that we were at the beginning of this 5-year plan.
And Pankaj, I was reading a report that mentioned how historically during every down cycle or slowdown where global markets are concerned, your company has managed to pick up attractive assets at distressed valuations, which has always fueled the next leg of growth for you. Are you scouting for similar opportunities this time around as well? Any ballpark figure you've earmarked for inorganic growth?
As you know, our company doesn't acquire because we want to acquire some asset, but the most of the acquisitions have come at the behest of the customers. So as we speak, definitely there are many assets about which we are discussing. And so if everything goes well, you will hear, but acquisitions are such a thing till the whole thing is concluded. We really do not know which way it goes. So while we are an acquisitive company, but we are very balanced in our approach, we want to create value for all the stakeholders.
But
And
Kunal,
our leverage
yes.
ratio is being 1:1, so 1.1, which really helps us that we have a lot of firepower.
Okay, yeah, point taken. And Kunal, with the renewed excitement around aerospace and defense, is it fair to assume the next acquisition could be in these divisions?
Oh, absolutely. There is nothing that is saying that we will only do acquisitions in one segment. I think what Pankaj was mentioning was that we remain customer-centric, and that's the same philosophy we have in the non-automotive part of the business as well. So subject to customers providing us these opportunities and these insights, we were and we will always be looking out for acquisitions.
And Pankaj, what's the latest on the net debt position on the books? And going forward, is the focus to bring that down, or are you comfortable maintaining the debt at current levels given your expansion plan?
So we are a growing company, and as part of the growth path, we have kept a very disciplined approach to cash management. As of now, we do see a working capital a bit inflated, which is because of the very dynamic market in which we are operating. So all the companies are working to continuously optimize ourselves, optimize all our costs, and also optimize the working capital. And that's the way for us to continue to grow and remain reflective of the realities in the market.
All right, Pankaj, Kunal, we leave it at that. Thank you so much for joining us, giving us that perspective, and we let